Hello, everyone. Welcome to this quarter's edition of our Weight of the Evidence call. We've got a really good lineup for you. These calls have been great. They've been really well received. So we're happy to have so many people logged on and ready to see the information that we've got. Before we get started, just wanted to run through a few different housekeeping items. This call is eligible for 1 CE credit. For live attendees, we've received your CFP or your SEMA number from the registration page, and we will process that when the registration or when the webinar concludes. You have to be on for 50 minutes though in order for us to process that. If you're viewing the replay on-demand viewers, there'll be a 10-question quiz at the end. And once you complete that, you'll get your CE credits. We also have some materials available in the panel on the right-hand side. You can download those. And also, we're going to try to leave some room for Q&A at the end of the call. So there is a box where you can submit Q&A questions, and Miles, Yanni, and I will try to get to those at the end of the call. So the speaker lineup today is really good. My name's John Lewis. I'm one of the portfolio managers at Dorsey, Wright. And then we've got Miles Clark, who is one of our analysts out of the Richmond office. And finally, we'll hear from Yanni, who is head of investment insights for our capital access platforms at Nasdaq. Yanni's going to come on and talk to you about kind of the fundamental picture of the market and where we stand with different things there. Miles and I will really go over things from a technical standpoint. So for Miles and I, what we want to go over today, right? We'll start with domestic equities, just kind of give you a state of the overall market. We have a lot of stuff about seasonality. I think we're in kind of a very interesting spot in terms of that. We'll go over momentum. You guys all know that Dorsey Wright is really known for relative strength and momentum. We want to do a bit of a deep dive there and talk about what we're seeing in different areas of the momentum market. And then also go over some of our participation indicators, things like that. We also want to cover international equities and some of the other asset classes, commodities. They've been that's been a real interesting spot in the first quarter, fixed income, that sort of thing. And then we'll turn it over to Yanni. So for those of you on the call who don't know a lot about Dorsey Wright, we have 3 business lines at Dorsey Wright. So we do asset management. We have separately managed accounts on a bunch of different SMA and UMA platforms. And there we have everything from straight domestic equity portfolios to international to fixed income. So if you're not familiar with us, look on your platform, see if we're available there. We also create a lot of indexes that get licensed out to different ETF providers. So you can access our methodology through different ETFs with Invesco, First Trust, Advisor Shares, Pro Shares. So we have a number of different partners that that license our indexes and then put out different ETFs. And finally, we have a research platform. A lot of the people on the call are subscribers to the research platform. We have daily commentary every day. We have rankings on stocks, ETFs, things like that. So if you're not familiar with our research platform, you can just scan the QR code that's up there on the screen, and we'll have that available again at the end of the call. So if you miss it right now, it'll be there at the end of the call. But you can go to our research hub, which we have pictured here, and you can get a bunch of free information there. If you want kind of more in-depth stuff, you can register. And then we also have subscription packages available there as well. So looking at what happened in the first quarter of the year, it's very interesting, and it is very different than what we've seen the past few years. So this is just more of a historical look going back to 2016. These kind of performance quilts, we run a lot of these at Dorsey Wright, and it's just a nice graphical way to look at what different asset classes performed well in any one given year over time. So what you'll notice looking back historically, we've had a huge run of large cap and growth specifically. A lot of the mega cap tech names have really been the leadership. With a few exceptions, we've had some kind of starts and stops throughout the period that we're showing here. But you see like QQQ up there at the top of the list for many years. You see cap weighted S&P has been a very good performer over kind of the history of this. But to start 2006, we've definitely seen a shift in what is performing well. All right, so drilling into 2006, I had mentioned that the cap-weighted S&P, for example, had really been where you wanted to be for years, kind of heading up to this. That's really changed. So when we look at performance for 2026, XLG, that's kind of the mega cap names, that's down at the bottom of the list. That is a big change. We've also seen RSP, which is the equal weight S&P 500, perform better than the cap weighted S&P 500. So for those of you who aren't familiar with that RSP product, it's the same names from the S&P 500. They're just equally weighted every quarter. The regular S&P 500 that people know and that's quoted on CNBC and those kind of places, that's cap weighted. So a larger stock gets a larger weight in the index, for those of you who don't know that. So we've seen better performance out of small caps, out of mid caps, and that's really reflected in this chart here. The second thing that we've seen is a continuation of this international outperformance. So emerging markets performed really well in the first quarter of the year, but EFA, which represents developed markets, is also up in the top half of those rankings. So that trend continues. We generally have had a longer term trend of a weaker dollar. We've had, since the war in Iran began, we've had the dollar rally, but that longer term downtrend still does kind of remain in place. And that has proven to be a tailwind for international investing in emerging markets in particular. So kind of having said that, I think this is really the argument for having a tactical kind of systematic approach, because these asset classes perform well at different points of the cycle. We're not always sure when something is going to perform well, when it's going to drop off, but using our Dolly matrix, for example, which is our asset allocation matrix, or any other type of momentum-based model, will help you shift your portfolio around over time and overweight and underweight different things to try to capitalize on where the strength is at any one given time. So where we are heading into Q2 in terms of overall asset allocation, and what I'm showing you here is our Dolly asset allocation model. All of our Dorsey Wright subscribers are familiar with this, but what we're trying to do here is just from a very high level, show you where the strength is, where the weakness is. And if when you're running client portfolios, we want you overweight those things in green that are shown on the left, and then underweight those areas that are in red or on the right here. So we have international equities sitting at the top spot. That Dolly #1 level and that top spot has really been the bulk of all the outperformance over time in terms of asset allocation. So we would want you to be kind of overweight in international equities right now. We have domestic equities at #2, commodities at #3. Commodities have been very interesting. We'll dig into that a little bit more, but that had really been driven a lot by that precious metals trade. More recently, we've seen energy pick up and kind of carry the mantle there. Fixed income remains a tough area to be in. That's an underweight, and it's been down on kind of that underweight and that last place in Dolly for quite some time. So we're going to drill into those asset classes a little more. We'll start with domestic equities, which is really kind of what most people are focused on and interested in. Let me turn the call over to Miles, who, as I mentioned, is one of our analysts that writes for the Daily Equity Report every day. So Miles, if you would, just kind of go over what you guys are seeing in terms of performance out of the various indexes.
Sure. Yeah. Thank you, John, and thank you to everyone for spending the afternoon with us today. Going to be going through again, as you mentioned, John, kind of a high-level technical picture of some of the major indices that we're all pretty concerned with as we move into Q2. We would be remiss if we did not throw in a couple of P&F charts, but I'll tell you, I'll do my best again to keep it high level. So even if you aren't a P&F expert, we'll be able to kind of get a high level view of where we stand moving into April. So we'll start off here. That chart on the right is the default chart for the S&P 500 as of the end of the quarter. And we broke it down into a short, intermediate, and long-term picture. Now, starting with the short term, we have reversed back up into a column of X's here on our default chart, establishing some support really between 1 to 2% away from current levels here. But again, we could see some continued volatility here. So just keep in mind that that is a more short-term kind of lay of the land there for the broader S&P. What I think is really interesting here is going to be the intermediate into long-term picture. So in the intermediate term, you'll notice there we've kind of continued to grind lower in 2026, posting a string of 3 consecutive sell signals and really leaving a wide array of resistance between current levels and those all-time highs up around 6% away. But I do want to mention here, as we look at that red dotted line, which we would refer to as our positive trend line down below, that ultimately we're still in a long-term positive trend and have been for quite some time. So that positive trend line is around 10% away from current levels. Again, we would like to see domestic equities hold that, and really as long as we do, the path of least resistance is going to be higher again in the long term. So that's going to be kind of mission critical, especially if we see continued volatility as we move through 2026, or at least muted or continued downside action, that is. Now that's the kind of cap weighted S&P 500, so your big guys get a big say. But we can do a very similar practice for other areas of the market as well. In this case, looking at the equal weighted S&P 500, so a one stock, one vote approach. The default chart for SPX EWI is again over on the right side of the screen. Very similar picture, at least from an absolute perspective. We have seen a bounce out of oversold territory in the near term. In the intermediate term, continuing to move off of those all-time highs, leaving us with some resistance in the middle ground between current levels and those all-time highs back up from February. But again, although we are a bit closer to that positive trend line, we still do trade in a positive trend here. So this is going to be, again, another long-term tailwind for the average S&P 500 stock, and it's going to be very important to hold that long-term trend line as we move into Q2. The next thing I want to mention, or at least the last thing from an absolute perspective, is going to be the Russell 2000. Now, we have seen some deterioration on an absolute perspective, but some relative outperformance so far in 2026, which we'll talk about more in just a moment. But again, running into a short term, we've bounced out of heavily oversold territory. But in the intermediate and longer term, some damage has been done to the technical picture of small caps, mostly due to the fact that small caps really haven't been able to sustain long-term action over the last couple of years, at least from an upward price action perspective. So breaking back into a negative trend in 2026 so far, this is going to be important to watch as we look for participation outside of the core, and kind of see how that really leaves small caps, mid caps as well, as we move further into 2026. But John, as we look at the absolute pictures for a lot of this stuff, we are seeing some absolute deterioration. But at Dorsey, right, we don't just look at absolute pictures, right? We look at relative strength. And there has been a lot of relative shifts worth watching as we've gone through the first quarter, shifts that are important to monitor going forward. So why don't you come back on and talk about some of those shifts before diving further?
Yeah, thanks a lot, Miles. So I talked earlier when we were looking at those performance quilts about some of the shifts, and here's one of them. This is a relative price chart of the S&P 500 cap weighted versus the S&P 500 equal weighted. So remember, that's the equal weighted it's the same 500 stocks, just a different weighting scheme. But when that ratio is falling, and you saw that fall quite a bit from kind of the top of the internet bubble all the way into the financial crisis. That was a time when the cap weighted S&P was really the laggard. Small caps, equal weight, a lot of other things were doing much better than the S&P 500 during that time. We have seen that ratio reverse back down. It has not given a sell signal yet, but that is kind of the first move that we've seen. We've seen that come down. It would be great, if we see a sell signal, that will just be further confirmation that we're probably in a more durable trend of kind of cap weighted underperformance versus equal weight. The second one that we want to show you is a chart of the S&P versus the Russell 2000. So large caps versus small caps. We're seeing a very similar picture here. Notice that you'll also see the downtrend from the kind of the internet bubble through those kind of 2000s. You see that downtrend indicating that small caps are outperforming. We've seen that ratio reverse back down again into a column of O's. Again, we haven't seen a sell signal yet here. If we do see that, that is just further confirmation that it is probably a more durable trend of cap-weighted underperformance. And finally, the last one that we'll put up here is just a value versus growth chart. So we saw this start to shift late last year. Value has definitely picked up. This is one that has reversed to a column of O's, meaning value is outperforming. Again, just like the other two charts that I have shown, we haven't put a sell signal in yet. So it's more of kind of a shorter term move at this point. Seeing a sell signal would, again, give us confirmation that this kind of value outperformance would be a more durable trend. But these are kind of big shifts that we're seeing. It could be very early in this. Large cap growth has really dominated the landscape for quite some time. So seeing these three different relative charts change like they have is an indication that we might be seeing something different. And over the next few years, we might have different leadership than we've had in the past. So those are some relative charts there, but also we do like to look under the hood at what's going on an individual stock level inside of these indexes. Dorsey Wright has a ton of participation indicators. Miles, we have a few that we'd like to show if you come back on and kind of talk us through some of those.
Yes. Yeah. Thank you, John. Like you mentioned, when you talk about what is driving markets higher or lower, participation is really the name of the game for Dorsey Wright. In that regard, what we'll talk about is, again, what is driving movement, and the elephant in the room is really that domestic equity participation has fallen. Now, again, when we say participation, we're really asking the question: what percent of a universe exhibit a trait that we desire? In this case, when we're talking about the strength of long-term equity or long-term domestic equity strength, well, Dorsey Wright utilizes what we call the PTSPX, or the percent positive trend for the overall S&P 500. In layman's terms, this just measures the percentage of S&P 500 stocks that are trading in a long-term positive trend. We want this value to be high. Now, again, as I mentioned before, we've seen this value fall in Q1, which is, of course, moving in the wrong direction. But just to contextualize this decrease in participation that we've seen in 2026 to some other major market declines in recent history, we can look back, for instance, in 2022, that chart action on the left side of the chart there. We saw values sitting at or below 50 for the majority of the year, reaching actually as low as nearly 20% at some point there before kind of bouncing back and forth. Similarly, right, in 2025, during the April tariff tantrum nearly 1 year or roughly 1 year ago, we fell down to about 30% before swiftly moving higher. So again, although we have seen a decrease in long-term participation so far in 2026, at least by historical context, we're still in, quote, clear waters. Now, it's going to be really important to play some defense around current levels. We really don't want to wash out here. That's where a lot of danger can come into play. But again, that decrease that we've seen so far isn't necessarily a major concern just quite yet. Now, there are some seasonality, or actually before the seasonality, we'll talk about some of the overall sector shifts that we've seen. And this goes hand in hand with the participation, because I like to remind people, oftentimes or sometimes, participation and performance can diverge. And they can do so, they can diverge when the big guys are doing relatively worse or are really driving the magnitude of performance in one direction or the next. And that's really what we've seen in 2026. It has been those bigger areas of the market: technology, comm services, financials, consumer cyclicals, or other houses or sectors for relatively large names. We've seen those guys fall within the rankings, but ultimately that tech leadership remains defendable for now. We see the rankings within our Dolly group, one to open the year from a sector perspective on top, and then second to open Q2 with the again, that shift in rankings. You'll see technology moving from first to fourth, communication services moving from second to third. Those groups, again, are still in what we would consider equal weight territory. Meanwhile, other areas, financials and consumer cyclicals, moving from the top half to the bottom half. We'll talk more about financials later. But again, that tech leadership, that growth leadership wanes, but is, again, ultimately still acceptable, in at least in the intermediate to long term. What we have seen taking their place is a handful of smaller areas outside of the core, more value focused areas. Energy, utilities doing particularly well. Energy, of course, being driven by continued unrest in the Middle East. But point is, we're really having to see where there is staying power for some of these more value focused areas, or if we're just ultimately going to seed back into safety in the core or safety in size via technology going forward. Next, we can talk about now a headwind on the seasonality front. And there's a couple of headwinds in play. I'll preface this by saying seasonality is seasonality. So keep that in mind. We'll take these studies with a grain of salt. But regardless, the first study on a seasonality front looks at the average S&P 500 progression during presidential terms. Now, this is any presidential term, right? So it's not Donald Trump or Joe Biden or whatever it may be. But you'll see here the average year 3, right? That's that green line towards the top. That's typically the most positive, while the average year 2, that's that full length kind of darker line at the bottom. It's actually the only only year that is on average negative throughout a kind of overall presidential term. Now, the reason for that, neither here nor there, but there is this idea of uncertainty really being in play for markets. And, like him or hate him, Donald Trump certainly brings in, elements of uncertainty into markets, but I'll highlight ones that are, more kind of reliable levels of uncertainty, that being notable moments of stagnation for markets at and around presidential elections, and ultimately midterm elections as well, which is where we sit currently in a midterm election year in 2026. And you'll notice there that once markets are actually able to digest the results from those elections, typically speaking, we see a bit of appreciation here, because again, markets dislike uncertainty. Regardless of who wins, right? Regardless of outcome, once outcome is known, then we can kind of move forward, digest that, and kind of go forward from there. So we could continue to see some ultimate volatility as we move further into 2026, with kind of that endpoint, at least from a historical average perspective, around the midterms. The other adage is this idea of a seasonal headwind in as kind of sell in May and ultimately go away. So this is a longer term market seasonality point that suggests you do exactly as such. You sell in May and you come back after the summer months when everyone's back from vacation, and you ultimately pick up markets back in November, which ushers in the seasonally strong part of the year from November to April. So all that to say, we've got a description or a hypothetical portfolio over on the right side. That blue line is our benchmark. That's just the Dow Jones over the last 75 years. Our black line only owns the Dow when our markets are in the seasonally strong part of the year, and the pink line there only owns when we are in the seasonally weak part of the year. You'll notice an obvious divergence between the two. Now, on that point, right? These are just averages, as I mentioned. You look back in 2025, we saw markets markedly positive throughout the seasonally weak period of 2025. The S&P 500 up 22.5%, the equal weighted index 11%, the Nasdaq 100 up around 32%. So these are just averages, and we'll certainly hope to buck those trends in 2026. And certainly, we'd be remiss if we didn't talk about some of the kind of seasonal aspects around historical war times. So this final quote seasonal chart looks at annual performance for the S&P 500 following major U.S. involvement in historical wartime events, in this case going back to Pearl Harbor and the initiation of World War II. And really the takeaway from this chart is that most of the time markets are able to effectively shake off historical or major wartime events on the domestic front. You'll see here, if you look at our 365-day hit rate here, your markets or the S&P 500 is positive around 64% of the time by about 7.5%, which is roughly in line with long-term historical averages. So again, that goes back to that uncertainty conversation that we talked about before. And kind of expanding this conversation out to other asset classes, we can do the exact same thing with a wider swath of investable assets. We will move past most of the assets which are neither positive or negative, but just on average, I will point out two notable outliers. Crude and emerging markets are notably positive following war times in the preceding year. And just to contextualize where we currently sit, crude, it's only been about a month or so since the initiation of these strikes in Iran. As crude up around 50% over that time frame through the end of Q1. Emerging markets of similar magnitude, but this time negative rather than positive in terms of its average hit rate. But here we'll bring on John, talk about some of the momentum trends that we're seeing and what we need to be watching out for in terms of overall leadership.
Yeah, thanks, Miles. So momentum is something that we are really good at Dorsey, Wright. We obviously follow it very closely, and we have a number of different ways to kind of look under the hood at momentum and what's going on. So in the first quarter, momentum did okay, right? We finished kind of ahead of the cap weighted S&P. We're using MTUM as a proxy here. Remember that that's cap weighted. I think if you look at it kind of an equal weighted momentum type of strategy, that did a little better. But it was interesting because as we got into the end of the quarter, momentum performance was incredibly volatile. So along with market volatility, momentum performance volatility increased quite a bit. And we had massive up days for the leaders. We had massive up days for the laggards. And it was like such a large up day at the very end of the quarter that kind of took that momentum performance where we needed it to be ahead of the benchmark. So that is something that that's not going to persist through the rest of the year, that volatility, right? That kind of momentum volatility doesn't last very long when we look at those types of things historically, but we do definitely get bouts of it. What can continue through the rest of the year is the good performance from momentum. A lot of people think if momentum has a nice short burst and a good run, that means it automatically has to reverse and the market has to totally change. But that is not the case at all. So when we look historically at how momentum has performed after a good first quarter, we have a chart here. If someone could advance that for me, it just shows momentum outperformance and then how the rest of the year goes, right? So if momentum performs well, the rest of the year on average tends to be good. So we're set up to have a decent year of momentum. That doesn't necessarily mean it absolutely has to happen, but the odds are in favor of momentum strategies. In terms of where we are on a seasonality basis here, the second quarter does tend to be very good for momentum strategies. Third quarter, when everyone kind of comes back from summer vacation and people start, updating their models and looking at the end of the year, third quarter is when a lot of market volatility and a lot of the market crashes have occurred. That is generally the worst time for momentum, but fourth quarter is usually very good. So second and fourth quarter tend to be very good. Obviously, we're heading into Q2. So that's definitely a tailwind in terms of the potential for overall momentum performance. When we break apart what's going on the large cap domestic side, we talk about the spreads a lot. We have weekly videos on them. And this is just momentum performance by quintile for our domestic large cap universe. You can see that bottom area, the laggards have had a very poor year. The laggards are definitely an area you want to avoid. Really, the only positive area in terms of all of those quintiles is that kind of upper quintile. And we can break that out even farther and look at overall deciles. And you can see how big of an effect the leaders and the laggards have had on overall market performance so far this year. That's where all the returns have been, either positive or negative. So this is definitely an environment, if you are doing momentum strategies, that you need to be cutting the losers out very quickly. You need to be moving those assets into where the leadership is, because that seems to be, at least for now, the only thing that's been working so far this year. We can also look at how momentum's performing on the international side. This is the quintiles for developed markets. IRS is doing fine. The laggards on the developed side have performed very poorly this year, so that's really helping momentum performance. Finally, on emerging markets, this is kind of what you want to see here. You have the upper end of momentum is the best performing area. You have the laggards not performing very well. So we've seen a definite pickup on the emerging market side in terms of momentum. Heading into this year, developed markets, we had seen the best performance for a year and a half or so out of those indicators on the developed side, but that's kind of shift over to emerging. We've definitely seen a pickup there, and those indicators are looking much, much better. And, a big kind of driver of all of this international performance is the US dollar, right? That does have a big effect on different asset classes, international equities in particular. So we'll bring Miles back on to talk about what we're seeing in terms of the US dollar and how that's affecting some of the other asset classes.
Sure. Yeah, thank you, John. As you mentioned, the US dollar is going to impact a wide variety of areas around the globe. International equities, as you mentioned, being one of them. Commodities priced in US dollars are also significantly impacted by further rises or falls for the greenback. And as you mentioned, the strength of international equities, even to open the call, we talked about the strength for international equities being persistent over the last few years. Most of that has coincided with a significant downdraft for the US dollar as we re-entered a negative trend earlier in 2025 and have really just continued to grind lower since that point. Now, historically speaking, the dollar has been an asset that tends to trend with relatively consistent movement in one direction or the next. Now, there was looking at this P&F chart here, there was a bit of a kind of a blip or kind of an oddity of movement where we saw back and forth movement throughout 2023 into 2024. But ultimately, in kind of moving into 2025, has continued lower. Now, with the unrest in the Middle East, we saw the dollar strengthen a little bit and actually return to a buy signal here on our default chart for the dollar. But ultimately, that long-term negative trend remains the priority. And as long as that trend line, or as long as that trend remains in place, that negative trend, we're going to continue to see that as an ultimate tailwind for international equities. Now, we get a lot of questions all the time of international equities can be difficult to go pick up exposure to. There's a lot of different countries available. There's a lot of different styles. There's a whole bunch of different risks associated with international markets, rather than just going and picking up, your run-of-the-mill tech stock on the domestic front. So to quantify or help visualize the strength across the globe, Dorsey Wright utilizes what we call a relative strength matrix. And that matrix ultimately takes a whole bunch of different individual relative strength charts, and then just ranks these assets based on which one earns the most relative strength buy signals, or again, in layman's terms, is just the strongest in that respective universe. We can do this for anything. So we can look at this for individual stocks. We can look at it for ETFs, mutual funds, broad asset classes, intra asset classes, individual sectors. You get the idea. In this case, what we can do is actually take 41 different country representatives and look at the top half, in this case, as points of relative strength. They're the ones that are at the top, rising to the top like cream, and we want to avoid everything else that's going to be at the bottom. So to kind of usher in that visual, We'll move on. And again, these are the top 20. So these are all relatively strong. You can see them there. Israel has moved higher. Korea, Colombia, Hungary, Peru round out our top 5. You can obviously see the names, but what's more interesting is actually to go look at two things. One, where the rankings sit in terms of overall composition. And then second, what areas moved in Q1 that we might want to be aware of. So breaking down the first top half composition graph or table first, you'll see that we had 4 representatives coming from either emerging or developed Americas, 4 coming from Asia Pacific region, most of those coming from the emerging front. But where the strength has really been, really for the better part of the last year and a half or so during this international, period of excellence from a performance perspective, has been the European stand front. We've seen, particularly on the developed front, we see 7 representatives out of the top 20 coming from that developed Europe standpoint, and they continue to be a point of relative strength, ushering in a strong period for momentum strategies, which are able to grab hold of that trend. Now, when we talk about trends emerging or maybe dissipating, we can take a look at how things shifted during the first quarter. Most of the strength seeding from emerging Americas and moving towards other developed markets, particularly again on that European front as we highlight that, but also on the Asia Pacific area, particularly coming from Korea, which moved higher. So point is that we're continuing to see Europe do well, and then continued rotation towards your developed areas of the globe. Now, let's see, moving on to the next slide, we can take a look at just an absolute picture, again, for a broad representative, ACWX, doing a very similar kind of process that we did earlier in the call, but now we have a slide to look at it with it as well. Here we have, again, ACWX, the default PNF chart, and we've noticed that we have bounced back out of heavily oversold territory and maintain our long-term positive trend. And that's the key at this point. Despite exhaling off of these recent 2026 highs, we've ultimately established some near-term support. And the big key is it's above a big range of old resistance that we had struggled to get past, really coming out of 2022 and in 2021 at that point. So again, putting in some near-term support is certainly a positive. Now, moving forward, we can take a look next at the other areas. Let's see if we can get the slide to move forward. Your commodity focus group. We've seen, as John mentioned, lots of volatility in the commodity space group within our broad rankings. Commodities moving from 3rd to 1st to 2nd, back down now ultimately to 3rd, and a lot of the volatility being spurred on by your energy focused commodity groups there with unrest in the Middle East. So we've seen energy focused areas move from bottom to top. Meanwhile, previous points of relative strength in precious metals, namely gold and silver, have rolled over, and they have actually fallen down to the bottom of the rankings. So as long as that volatility stems out of the Middle East, we're probably looking at a kind of a higher energy complex, which is going to continue to see energy focused areas garner relative strength within the intra commodity rankings. Now, speaking of the volatility, to quantify that, we actually took a look at the rolling 30-day standard deviation for crude, silver, and gold. Now, the point of this here is to mention that we are going to continue to see, or have seen, some jockeying for control as long as volatility stays elevated. To kind of visualize it, silver volatility measured by that 30-day standard deviation, the highest in our recorded history there, dating back to 2000. Crude, spikes, not as much, of course, as the COVID-19 pandemic there. Gold, very similar. So all this to say, we could see some continued jockeying for control in the intra-commodity group as long as that volatility stays elevated. And we'll wrap up with some very quick comments on fixed income, which remains a relatively weak area of the market. But of course, for some of our clients, we need to have exposure to fixed income. So to help find those points of relative strength, we can look at the overall fixed income or intra fixed income rankings over on our asset class group scores page, which simply ranks the assets from top to bottom based on their longer term relative strength. So the groups towards the top here, convertible bonds, emerging markets, international markets in general, those continue to be points of relative strength. While your points of relative weakness, your all fixed income group looks relatively average to say the least. And then other points of weakness, U.S. Treasuries, areas further out on the curve, municipals, right? These are areas that we want to relatively avoid in favor of those other more kind of risk or international or equity focused convertible areas. Lastly, we'll wrap up with a very brief comment on private credit and private markets. And kind of how the technicals can help you address overall situations as they develop before some of the headlines, right? Private credit, private markets have been the talk of the town for the better part of the last 2 years. That's ultimately been associated or accompanied by rapid appreciation for private credit focused firms on the equity front. But ultimately in 2026, we've seen that fall apart. And so to quantify this, we actually created a basket of a hypothetical index or a hypothetical basket of private credit focused equities. And that chart is over on the right side of the page. And what we've seen is it fall down tremendously off of those recent 2025 highs. But the point here is to kind of show we saw weakness before markets rolled over in 2026, specifically last summer in August, where we saw a lower high be put in off of those 2025 and 2024 highs back from December of 24 and early 2025. So that, when we talk about being able to look through the headlines, look past the noise, using the technicals to identify weakening assets, not being able to really see demand continue to take over, that's really the name of the game, and why it's important to have a system in place to kind of choose relatively strong assets and avoid those that are relatively weak. With all that said, that covers the majority of the technical side of things. I'm going to invite on Yanni to go over some of the more macro fundamental side of things and go from there.
Great. Thanks so much, Miles and John. Really great overview. So let me dive into the fundamental landscape here. Hopefully do this under 15 minutes so we can have some time for some questions. So, of course, as Miles had alluded to throughout, it's really the energy supply shock and the geopolitical environment that's been driving the macro over the past kind of 5 to 6 weeks. So, going to show the next couple of charts here, things that we're well aware of now, but I think it's useful to help set the table, right? So emphasizing the importance of the Strait of Hormuz, right? This has been the largest foreign oil trade, goes through this narrow pass, 20% of global LNG trade. And looking at the next slide, where does this head to? The vast majority goes over to Asia, and this is looking at crude oil exports that pass through the strait by destination based on millions of barrels per day as of 2025. So again, the majority to Asia, a good amount to Europe, and some to the Americas as well. Now, I'm emphasizing this because keep this in mind when we start talking about GDP outlooks and forecasts, and also relative equity performance since the war has begun. Now, what does this bottleneck here mean? What does the effective closure of the strait mean for Brent on a go-forward basis? This was done by Bloomberg Economics. Very, very hard to pinpoint this, but the effective closure over the past month has sent Brent and crude, WTI and crude up over $100. We know that. By back of the envelope estimates here, if the Hormuz Strait remains closed for call it around 2 months, you push past 130 to 140, and then kind of a quote unquote worst case scenario for the markets would be seeing things past the 150 to 160 type of range, right? So a lot of unknowns, a lot of uncertainties depending upon the duration of the war. And as Miles alluded to and John alluded to, right, this can literally change minute by minute depending on a social media post. So heads on a swivel here, hard to really get a lot of signal through this noise at times. Now, in terms of the impact on growth and inflation, Goldman here looked at the estimated effect of oil prices over the next 12 months on GDP and inflation, right? And on the left-hand side here, the red arrow is pointing to the US. Call it shaving off of around 30 basis points from expected growth forecast over the next 12 months. But if you move further right in terms of the GDP impact, right, you really start to see this hitting the likes of Asian economies, hitting the likes of European economies, who are more dependent on this imported oil coming from that region. And then also in terms of the headline inflation impact, right? Call it around 60 bips added to US inflation, which would, of course, take inflation even higher above where we are in terms of the Fed's comfort zone and their target rate. But again, on the left-hand side of this right-hand chart, you're seeing the impact really taking hold in the likes of Asia and the likes of Europe and those economies. Now, in terms of the forecast, right, what have the economists been building into their forecast? The answer is really not too much. On the left-hand side, just as a proxy, this is looking for a 2026 GDP growth forecast on a year-over-year basis across the Eurozone, Japan, China, and the US. And it's really been wait and see mode, right? Because kind of similar to what we saw during the tariff tantrum, folks wanted to see how things panned out, how the dust settled here. So you're somewhat surprisingly, given we're 5 or 6 weeks in, you haven't seen a lot of changes here in terms of Bloomberg median forecasts. If we're looking at something more real time, and this is in red, this is the Atlanta Fed's GDP now. So it's a nowcast, and it's taking the current data in hand and adjusting the series in terms of what Q1 GDP would be right now on a quarter-over-quarter annualized basis. And you can see we started the year at around over 5%. Now it's down to around 2%. And we really haven't gotten a lot of the March data in hand. So we'll see how this materializes. So I think something interesting to watch in terms of a nowcast indicator. Now, why are economists and macro folks maybe suspecting that there can be a buffer here in terms of growth forecasts? It's on the right-hand side. And this is the expected fiscal impulses headed into 2026 across these three large economies here. And this is a combination of just general fiscal spending, defense spending, and the likes of the US, the tax cuts, right? So you're really starting to see these fiscal impulses potentially be a buffer. The question is, and the issue is, the longer this conflict exists and takes place for, the more it's going to erode in terms of having that buffer in place. Now, as I showed earlier, right, you're getting this impact in terms of inflation outlooks, and the markets are pricing this impact in a real-time basis. And in blue is the 1-year market-based inflation measure, and then black is 2-year. Green is the 5-year break-even, right? And the break-evens are TIPS yield minus the closest Treasury maturity and subtract that nominal yield, right? So that gives you an idea of a market-based indicator in terms of inflation expectations. And you can see 1 and 2 years have really shot up. Now, why is this important? The markets have moved to price out central bank cuts, right? And if we're looking at the right-hand side of this chart here, in black is where we were the day before the Iran war started, right? And the markets are pricing in over 2 Fed rate cuts by December of 2026. Now, basically pricing them out. And it's even more egregious, if you will, in Europe. In the ECB, the markets are now pricing close to 3 rate hikes. And for the BOE, pricing in close to 2 rate hikes, right? So they're really taking what's been happening on the left-hand side in terms of this inflationary impact and higher inflation expectations and translating that into the market pricing for central bank rate outlooks. Now, personally, I think the markets are a bit offsides here, right? And I say that because in the beginning, yes, it's a supply shock, higher energy prices. This is an inflationary risk, an inflationary concern. But at some point, the inflation risk flips to a growth risk, right? And when we're if it happens to be a growth risk, the central banks aren't exactly going to be looking to raise rates, right? They'd be in rate cutting mode. So I think we could be getting closer to an inflection point the longer that this conflict persists. Now, translating this into the markets, right? It's obviously been a risk-off environment and more volatile markets amidst the geopolitical uncertainties. Now, I think it's always healthy to take a step back and look at historical precedents around such events, right? And not everything is going to rhyme right here, or not everything's going to mirror itself, but it can be similar. And if using the left-hand table as a proxy, we go back over 80 years to World War II and looking at when there have been major US military actions. And on average, US equities have risen by about 5% over the next 3 months. Not trying to discount, the humanitarian issue that's going on the ground, obviously, and the complete unknown still. But the point is that US equities over time digest this, readjust, and move on, right? So just to keep that in mind for historical precedents. Now, focusing on the real time. And as I mentioned earlier, right, it's really the European and Asian economies, which are the large energy importers, okay? And what we're doing here is on the x-axis, this is the net energy import, right, in terms of percentage of total energy use. So you can see in the bottom right-hand quadrant, a smattering of European and Asian markets, right? And on the y-axis, that is the performance since the Iran war started. And the markets, as they tend to do, have been pretty efficient in terms of pricing in the relative winners and losers, right? So you're seeing these Asian and European economies really underperform as they're the ones who are naturally picked off, given the reliance in terms of energy imports. Now, if you go to the top left part, right, those are effectively the energy exporters, the ones who are more self-sufficient, self-reliant, if you will, in terms of energy. And yes, they're negative for the most part here, but on a relative basis, really outperforming those other markets. Now, taking a step back and looking at things in a cross-asset perspective globally, right? And particularly focusing on the black lines here, which is since the Iran war started at the very end of February. Obviously, it's been crude oil, right? As Miles alluded to earlier, up around 50% since the start of the war. There hasn't really been anywhere else to hang out. And for safe havens, the one that has worked, the one ballast, is the US dollar, right? You've had Treasury 10-year yields in terms of total returns right there in the middle. Those have been negative, right? And that's really because of these inflation concerns and deficit concerns being priced into fixed income as the US 10-year sold off, hit over 4.4%, which was the highest since the middle of 2025, right? So this higher dollar has been a headwind for the likes of EM equities in the short term. And again, going back to those names or those countries, that have been more in focus in terms of large energy importers. You're seeing Asia Pac equities lower, you're seeing European equities lower, and international overall relative to the US. And again, just a quick chart here to put the fundamental spin on it, right? Stronger dollar here in black, down is higher. So as the Dixie has appreciated as a proxy for the USD index, right? You've had EM equities selling off. Now, to be fair, we had reached multi-year highs in terms of EEM as a EM proxy, but the dollar headwind, continues to be an issue for EM equities. But again, if we look at back over time, right, since the GFC, this is global equity rolling returns on a 3-year basis. On the right-hand side, US has vastly outperformed international. So there is still room to catch up, and international equities have had a very strong year and a half, running into some headwinds here for the reasons we've noted. But again, just to keep things into perspective in terms of the potential headroom here that international equities have, assuming we can get by this conflict in due time. And then focusing on the US, right? On the left-hand side, just kind of thematic approach, if you will, in terms of year-to-date in blue, and then in black is since the Iran war. What I will highlight in blue, as John and Miles had talked about, is here too, right? You're seeing this value play in the US relative to growth really outperform on a year-to-date basis. And value, of course, has been driven on the right-hand side on a year-to-date basis by the likes of energy, materials, and utilities, right? So really has turbocharged this relative outperformance in value versus growth on a year-to-date basis. Now, look, for US equities, call it down around 5-6% since the war started. Certainly there's been a shifting in terms of under the cover moves, but in all honesty, equities have been fairly resilient. Risk assets have been fairly resilient, all things considered. To me, that means that the full downside risks have not been priced in here, right? And that, of course, is the big unknown. A lot of variables into play there. But the point is, things have sold off, yes, but not to the extreme and not as egregious as a full kind of downside scenario. Now, finally, from equity land, looking at some standard deviation moves here. Again, oil, it was compared to 4-year averages, was a standout here, around 6 standard deviations relative to its 4-year average. The VIX moved higher. And I'm mentioning this specifically in terms of forward returns as we look at the right-hand side. VIX peaked at around 33 in the near term at the end of March, right? And that puts it in the 5th quintile going back to 2000. So when you're in the top 20%, the median return on a forward basis for US equities is 5.5%. It's definitely not a linear move here because there are downside, right? When you go from point A to point B. But the point is, when you get to these levels, the forward returns have tended to be positive for US equities. But in terms of panic mode, US equities didn't hit that, right? The VIX hit around 52, 53 during the April time period last year, got around again to 32 or 33 this year. In terms of sentiment, right, we're looking on the left-hand side. This is retail flows. And then on the right-hand side, this is looking at hedge fund and systematic. Both of these cohorts in terms of the markets and the retail and institutional side hit -2 standard deviations, right? And it's only been a handful of times. So I think that's what supported the recent market bounce back and trying to find a floor here in the very near term, right? We'll see how things pan out over the next 24 to 48 hours. But I think this is what's set up for the short term, the short squeeze in the very near term. Now, finishing it off with just a couple of fundamental charts here. If we're looking at high yield spreads, right, those have come off here in blue, plotted against the VIX and VXN, which is the Nasdaq 100 in terms of equity volatility. But you're coming off of what were near all-time tights. So you're around 300 basis points on high yield spreads relative to treasuries, but still relatively in check. In terms of forward-looking indicators, Taiwan exports, those are a great global leading indicator as semiconductor chips coming out of Taiwan are at the epicenter and at the beginning stages of value chains, of supply chains for the electronics industry. This leads global ACWI EPS trends on a year-over-year basis, right? So global activity has not taken a hit as of yet, so something to watch in terms of forward-looking indicators. And finally, a couple of charts on EPS. Here, the main story is 7 out of 11 of the S&P 500 sectors. They're expected to have sequentially higher year-over-year EPS growth in 2026 versus 25. And then you can see EM, Europe, and Japan likewise as well. And this is a key construct, a key underpinning of the more positive outlook for equities on a 6 to 12 month basis. If this starts to change, right, this is from fundamental perspective is where we get concerned, in addition to if we do see earnings revisions starting to move lower. And finally, all we talked about last year were valuations in the second half of the year, right? In terms of valuations now, specifically in the US, look at the Nasdaq 100, right? That's trading below the 10-year median. Look at S&P 500. That came into the year about 19 to 20% above the 10-year median. Now it's right around that level. And more importantly, this has been driven more by earnings growth, as we see on the right-hand side, particularly the 2 left bars there. In blue, it's earnings growth that has been doing all the driving in terms of look at 1-year total return attributions for US equities. It's actually been valuation compression, right, that we've seen. So it's more about the E and not the P in this case. So with that, let me turn it over to John and Miles to wrap things up.
All right, thanks a lot, Yanni. That's always great insight that you have on the fundamental side, which we don't get a lot into at Dorsey, Wright. So it's really nice to bring you on once a quarter and kind of figure out what's going on. And before I let you go, the one thing we did get some questions in, and one thing I thought was interesting is if you have kind of any inclination about how long this war would need to go on before we do start to see major earnings revisions across the board?
Yeah, that's a really good question. And I think it kind of goes in lines with when you start seeing the forecast for economic activity taking a hit, right? So my best guess would be if you see this persisting probably over 2 months-ish, and then you start getting oil to that kind of, we're kind of 110 to 115 now, you start getting into the 120, 130 range. I would expect earnings revisions to start moving lower because it's really interesting that you really haven't seen much changes. To me, it's analysts saying wait and see mode. But again, a bit of a guess, but if we start getting past that kind of 2-month period and it starts flipping from inflation risk and concerns to growth risk and concerns, that's when I think you should start seeing companies talking about EPS outlooks more.
Okay. Yeah, great. Thanks. That's great information, Yanni. What we have on the screen right now for everyone is just a QR code to take you over to our research hub. If you're not a Dorsey Wright subscriber, feel free to click on that, go over, see what we have. There's free research out there for you, and then you can get more if you're a paid research subscriber, that sort of thing. I will make a personal guarantee, which doesn't happen much in financial markets, but I will make you a personal guarantee that if you go to the Research Hub, that site will work better than this webcast site. So there's that, and that you have my word on that. I do want to let everyone know that the slides will be available for download since, we had a problem at the beginning. You can go in and download those slides. We didn't get to show all of them, so please feel free to do that. There are CE credits associated with this column. Before we wrap it up, we're getting close to time, but a question did come in about defensive sectors. I'll kind of bring Miles in to talk about that. And Miles, like what from a sector standpoint, from our sector rankings, things like that, like what are we kind of seeing on the defensive sector side?
Yeah, it's a good question. And, you go back to those sector rankings, like the graph that we had pulled up from before, consumer non-cyclicals or consumer staples, they're still at the bottom. There is obviously a question, well, is utilities defensive? We've seen those guys rise up, but of course they have AI ties as well. But who really doesn't? And then ultimately the question is, we've seen this in more recently, but and don't quote me on this, is tech defensive, right? Do we see, cash is king, right? A lot of these big tech companies, we've seen kind of a flight to safety there. But in terms of the more traditionally defensive sectors, we haven't seen those guys appreciate quite yet. And really, it's been more of, like, hey, industrials, right, have stayed towards the top. And it's just been an area away from traditional growth into, again, some emerging leadership from industrials, utilities, but in the likes of what you would typically think for very defensive, we haven't seen a massive shift yet, or at least a long-standing one for that.
Yeah, and I think that kind of jives with Yanni's comments, right? We haven't seen massive earnings revisions downward. If we see, as Yanni mentioned, if this goes on for a couple months, we might start seeing that, and then we might start seeing some of those defensive sectors kind of move up in the ranks. But yeah, we definitely haven't seen that yet. So it's been interesting so far. Again, like to apologize for the technical difficulties that we had earlier, but thank goodness we got through them. Like I said, the slides will be available for download. There's some documents in that docs area that are available for download. Thank you everyone for sticking with it. I think it was great information. Sorry about the technical difficulties, but we'll be back next quarter to bring you the weight of the evidence call. We'd appreciate any comments that you guys have. I hope everyone has a great day, and we'll talk to you guys soon.